Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from the One Big Beautiful Bill Act to the OECD's latest developments. I'm Wade Sutton, leader of the International Tax Group in PwC's Washington National Office. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in New York City in PwC's Policy on Demand studio. I'm excited to have Rob Ozmun, state and local tax partner, and Monic Kechik, leader of the Federal Tax Services Group in Washington's national office. It's great to have you both on.
Thank you.
Thanks for having us.
All right, so today we're going to talk a little bit about the One Big Beautiful Bill Act. This is the reconciliation bill that was passed in Congress and signed into law on July 4th of this year. And I'm filling in for Doug McConey. He's away on assignment. But if he were here, I'm sure he would weave in a reference to baseball. And so I thought an apt theme for today's show would be curveballs, which is the unexpected things you didn't see coming. Before we get into the curveballs, though, I want to ask you all each a softball, which is, what is your favorite Thanksgiving tradition? We're sitting here in November. The holiday is right around the corner. What do you like to do on Thanksgiving?
Usually pack up the family and the dogs and go upstate to a cabin. So my the solution usually is getting away from everything and going upstate.
Thanksgiving's always about the Lions game, and then it dictates whenever dinner is going to be. So if they're having a bad game, we're having dinner at halftime. If they're having a good game, it's after the end of the game. So lately it's been after the end of the game. Let's hope it's the same this year.
All right. Well, they're pretty good this year.
Yeah,
so
they are.
Those are both great. All right. So now let's move on to the curveballs, which is the OB3, which was passed, had a lot of new provisions or extended benefits from the Tax Cuts and Jobs Act. And those we're just sort of discovering after the bill was enacted how those are interacting with other provisions of the code. And there's a lot of, I would say, surprises for companies as they start to model this. Before we get into that, though, Monic, maybe you could give us an overview of what were the really important changes from your perspective that have been affecting your practice?
Yeah, it's really the three big provisions that that impacted the taxpayer. So it's 163J, so limitation on interest expense deduction. So ultimately now, companies are able, for purposes of calculating ATI, they are able to add back depreciation and amortization. So a lot of companies wanted that in order to be able to deduct more interest expense. And so that is now becoming effective ultimately in 2025. There's also some ordering changes just around the interaction of elective interest capitalization provisions and 163J applying earlier or before those provisions, and that's effective for 26. Then the big one, 174 Cap A. So no changes on the foreign side, still continuing to capitalize and amortize. But on the domestic side, companies can now deduct these costs going forward, which is kind of the default method, or they can capitalize and amortize over a period not less than 60 months.
Yeah, and just for the audience here, 174 is the provision governing the deductibility of research and experimentation cost.
Yeah, so again, no changes on the foreign side. And yes, on the domestic side, we're ultimately reverting back effectively to pre-TCJA law, where you could just expense it or electively capitalize these costs over 10 years, over 5 years. There's some nuances to these elections. But it also, for a lot of companies, which I think is really important as companies consider what they're going to do, is what to do with the unamortized costs that are remaining for the costs capitalized in 22 through 24, because they either can continue to amortize it over the remainder of 5 years or take it over 1 or 2 years. So a lot of optionality and therefore a lot of impact in the current year potentially.
So it's kind of like an accordion. These prior deductions, you could smush them into 2025 or 2025 and 6.
Yes,
okay.
Yes, exactly. And then the other one just is bonus. So again, another provision that can have a significant impact on taxable income. So any property acquired and placed in service after January 1st, 2025, now can go back to full expensing 100%. Some optionality, again, is that companies could, for the current year, continue to use the 40%, which was ultimately the phase down of under TCJA of bonus. And they even could elect out if they really wanted to, which I think companies are considering. The new provision is just one where you now potentially can take bonus on that non-residential real property, so building the property that usually was accepted from bonus depreciation, but now if you meet certain requirements that it's used for qualified production activities, you potentially could also take bonus on that, which I think can be exciting, but a lot of nuances in that rule as to what the definition of all these terms is.
So that's pretty significant because the depreciation life on non-residential real estate is pretty long. How long is it?
39 years.
39 years. So instead of 39 years, you can now deduct the expense immediately. And that's kind of interesting because I think here in the US, there's quite a bit of construction activity going on, particularly around data centers, places that are providing cloud computing capacity or training AI models. And I think there's a question about how that provision applies in this context. Can you tell the listeners a little bit about what's going on there?
Yeah, a lot of, as you mentioned, we're getting a lot of questions on data centers. The issue at this point in time is that because it's such a new provision and we've never had it, it has, as I mentioned, all these terms of like qualified production activity. And what does that mean? Is it manufacturing? Generally, I would expect it more to apply in kind of a manufacturing context, so companies that are producing tangible property. But right now, the term is fairly broad in how it could be applied, so it just depends on what future guidance is going to provide and whether data centers would be something that would be covered.
So the ink is not dry here yet.
Correct.
Okay.
Definitely.
Rob, these sound like a lot of federal goodies, I think we'll call them. States are not known to have very robust budget surpluses. They're always, I feel like, very much on the margins or even running deficits. And so I would imagine a lot of them who follow federal tax law were pretty dismayed to see all these changes that may have very negative impacts on their budget. So I live in Washington, D.C., where we just passed an emergency budget resolution to decouple from the federal tax code. And on several of these items, most notably, no taxes on tips and overtime. What are you seeing with the states here? How is this going to impact them?
It started off slow at first, where we started just hearing reports about what it was going to do on their budgets. So if we focus on DC, just as an example, maybe then we can step back and talk broader, right? They also are dealing with budget issues. And unlike the federal government, states and even DC can't really run a deficit. They have to have a balanced budget, right? And things like that. So as a result of that, with the implications of OB3, right, they need to figure out what it's going to do to their revenue going forward. And so DC's Emergency Act actually includes not only the tax on tips and overtime, it also includes decoupling from a bonus on buildings, right? They're going to decouple from the changes on R&D, and they're going to decouple from the changes on 163J. The interesting thing about DC is when they pass emergency bill, it's temporary. Right, so this emergency bill isn't permanent law for the first until such time that they actually pass the act, and then it goes to Congress and sits for 30 days. So they'll have to keep passing this emergency act over and over again until they can actually get the law enacted. From a broader state perspective, the starting point, like any conversation with a state person, you start with what we say is conformity. How do the states conform to the code? They're not required to conform to the overall federal code. They elect to do so, right? Most people have done that from an administrative ease, but they'll do it at certain points of time. And like on your side of the world, we talk about like all the different countries and their rules. We have 50 little countries in the US, even though they're under the United States. Each of them are allowed to do their own like taxation of corporations and other individuals based upon how they want to adopt the code. And so we will talk about fixed conformity, annual conformity, or rolling conformity. And all that really means is at what point in time have they adopted the Internal Revenue Code if they're following that protocol. So a rolling conformity state, when you hear that term, means that they've adopted the code, but the story doesn't stop there, because they may have then started modifying or decoupling from the provisions that Monique talked about, right? Or states may be in what we call an annual conformity state, which means they're a point in time, but then on an annual basis, they tend to update the code and get it more conforming.
So they would say, as of January 1, 2026, we are, or pick a date, we will adopt the federal tax code as it exists at that moment.
At that point in time. Yeah. So Florida's a great example of that. They passed their code conformity in June 30th, 2025, as of 1/1/25. So their code as of today is not OB3 compliant, if you want to call it that. They're stuck in basically the code of 24. Yeah. And so they're thinking about TCJA and the implications and other things, although they have decoupled from QIP way back in the day of the CARES Act.
Sorry, what is QIP for the listeners?
I'm so sorry. So when the CARES Act happened, right, there was a legislative fix around bonus depreciation to make leasehold improvements subject to 15-year qualification of amortization and depreciation, which made it eligible for bonus if you followed it. So when the CARES Act happened in 2020 to fix what happened as part of TCJA, Florida decided to opt out and kept that piece, that leasehold improvement, at 39 years. So there's always it depends in the state world. One last kind of version of conformity for states is we talk about fixed conformity. It sounds like the annual I talked about, but they tend to be stuck in time a little bit longer. So like New Hampshire is a good example of it. They're stuck in the code as of 2018. So that means they haven't adopted the CARES Act. They haven't adopted the OB3, right? So I have to actually determine federal taxable income as if I'm in 2018, right? And then when you have provisions that have expirations, like the CFC look-through, right? That provision's expired for purposes of New Hampshire. So it's just all this, kind of odd things to think through, which is why it's really important for us to be part of the conversation early, right? We don't want to just keep it in looking at the federal lens. We're going to be looking at it and asking you to kind of do it 4 different ways.
Yeah. It's interesting your comment, by the way, about states having less ability to run deficits, because everyone says the United States can't really default on its debt, and I think the implication is because we print our own currency, right? But states can't do that, right? You have to use the federal dollar. And it's sort of like the European Union member states, the same issue with the euro. So question for you. Some of these states have not adopted the very generous, particularly the expensing incentives. The idea here is trying to incentivize investment. So do you think we'll see a shift of projects from states that have not adopted these bonus depreciation enhancements to states that have?
When you calculate income tax, it's on the whole income of the entity. So location of property doesn't really matter. So if I decide, let's take, for example, California, they don't conform to any of the expensing items related to depreciation. If I put that asset in a state that does, like say Iowa, right, for California purposes, I have to redetermine it anyway. So the location of the asset doesn't matter. What you're going to see the states really do is use real incentives, I'll call it, to entice businesses to get there. Property tax abatements, favorable R&D credits, sales tax exemptions, these other things that will drive the business to come into the state. But from an income tax perspective, the bonus, the 163J, those provisions that Monique was talking about won't be the driver. Yeah. What drives the implication of that is how much activity they have in the state on their day-to-day business.
Is that like, sales would be a typical apportionment factor here?
Yeah. Yeah. So, back when I started in state and local many, many moons ago, we used 3-factor apportionment. So property, payroll, and sales, it was equally weighted. It came really out of the 50s. But over time, starting in the 90s, states have started to migrate towards single sales. They've ignored the property and payroll component and just source based upon revenue. And it can be the individual entity's revenue, or sometimes we do it as a group because they make us do group filings. But most states are single sales factor now, and that's how we then allocate or apportion the modified federal taxable income.
That's interesting. What you're describing, by the way, sounds exactly like Pillar 1, right? Which is a market-based apportionment of someone's revenue, even if they may not have a very big nexus in that taxing jurisdiction.
The terms you guys are using are the terms that I learned as an associate. So I'd say you're kind of like 30 years behind us. It's a joke, like, of what we're doing. Like we learned as an associate nexus. We talked about apportionment. We talked about market-based sourcing rules being the new cutting edge in the 90s. And most states have gone that way already.
We're slowly catching up to you. Well, the other funny thing is you mentioned that fine moving your project from California to Idaho may not give you any income tax benefits, but there are credits and incentives. We're hearing a lot about that in Pillar 2 as well, right? That the idea is if Pillar 2 is adopted widely across the globe, you're not going to see competition between jurisdictions on tax rates. It's going to be on credits and incentives. So again, maybe the international folks are just slow catching up to the state people.
But on the incentive part of it, I think the thing you would say even on the Pillar 2 is it's being there early, right? Hey, let's have a conversation before you just say, I'm going to put it in this country, or I'm going to put it in this state. Having that ability to kind of look at where you want to put it and think one state versus another or one country versus another gives you optionality, but also may give you some influence in negotiation.
Yeah, yeah. All right, so Monic, all of these really powerful incentives, in particular the ability to push old deductions that had been capitalized for research and experimentation into current years, this is creating some, I'll just call them unanticipated effects, where people are bumping into things like CAMT or losing some permanent benefits from, the FDII, I think we now call it FDII,
Yes.
or GILTI, which people call NICTI. Not there yet, but I'll get there eventually. So there's sort of a trade-off that we're seeing a lot of companies having to evaluate, which is, do I want my cash tax benefits today, which I would characterize as fully taking advantage of the benefits offered by the OB3 Act, or do I want to preserve my rate and make sure that my ETR, my effective tax rate, remains low over time? And what's going on here? Could you kind of explain that interaction for the listeners?
Yeah, and it's interesting because I think most companies want to keep the cash tax low, but also keep the rate low. So there's now ultimately this interplay between all these provisions that causes that to become complicated, that they have to pick which is the more important one, or where can they find ultimately the right balance between all these potential provisions. Because all the discussions we're having with clients now, a lot of them are saying, well, maybe I want to continue to capitalize because, yes, maybe BEAT, they have BEAT obligations. So anytime, especially when you're pulling expenses forward from prior years, almost like when you think about if you're taking advantage of all the provisions with respect to, for example, research and development, you're now pulling old expenditures into 25 and ultimately doubling up your expenditures for research and development in 25. And that means significantly reduced taxable income. And that could potentially mean that now when regular tax liability is low, that things like KMT that you didn't necessarily have to worry about before, all of a sudden now low regular tax liability could ultimately result in you bumping up into the obligation to have to pay KMT, to have to pay BEAT. And so those are, again, all of those tend to be more permanent, especially with some of the issues around KMT.
Well, let's unpack some of this for the listeners. So on the BEAT point, where I see this issue happen quite a bit is India is kind of a poster child for a country where you might do a lot of research. Why is that? Well, they have a humongous labor force that speaks English and is generally very well educated. Yeah. And so a lot of companies are using them for back office functions, for market support, for all sorts of R&D type activities. And if that activity is undertaken in a CFC, then the payment for those services, that's a BEAT payment. And so I think your point here is not only are you reducing your regular taxable income, but if you accelerate that deduction into 2025, that's a giant BEAT payment in that year, right? So I think that is pushing a lot of folks into BEAT. That's a permanent tax cost. The other, on CAMT, right, this is our book-based alternative minimum tax, where you take book earnings and you multiply them times 15%, and if that's generally lower than your regular tax, you owe CAMT, generally higher.
There, yes.
So I think the overall observation is for many of these expenses, at least R&E, those are expensed for book currently, right? And so the book expense that you would have taken into account for CAMT happened in prior years. So when you catch up to book with this acceleration election, right, you have very depressed regular taxable income and still high book income. I think that's pushing people into CAMT. So a question on that. When CAMT first was enacted, this was part of the Inflation Reduction Act that was passed during the Biden administration. One of the talking points I heard quite a bit was, well, that's just a timing issue, right? You pay CAMT and you get a tax credit. And if you ever have regular tax liability, you can use that tax credit against your regular tax liability. But I think that we're starting to realize that's not so true. And in fact, we've seen some companies, I think last week, we're recording this early November, disclose some very material expenses or charges related to the interaction of CAMT and 174. So why are these CAMT credits not as useful as I might have thought they were before?
Because it's called an ordering rule, which ultimately means that you have to look at, or you can only take these credits to the extent that the regular tax liability, which you adjust for credits such as the research and development credit and other potential credits. So you're reducing the regular tax liability, and then you're comparing it to your tentative minimum tax liability. And so to the extent that the regular tax liability is lower because of all the credits, you're not able to use the carry forward. And so now all of a sudden, yes, you have these carry forwards, and maybe companies initially thought that they would be using them fairly quickly. Now all of a sudden it's something where you may need to just keep carrying them forward because you keep generating, to the extent there continues to be research and development, you keep generating these other credits, and therefore it's going to be a hurdle to try to get your ultimately the regular tax liability to be above this tentative liability.
So that's interesting. You're saying even if my regular tax liability is higher than my CAMT liability, if I'm claiming other general business credits, that basically kicks out my CAMT credits and I have to save them for another day.
Yes.
And I think a lot of companies are basically there, where their regular tax liability is usually not going to be that much higher than their CAMT liability because of things like stock-based compensation. People are claiming much higher deductions under FDII. And so that then is why people are talking about a valuation allowance and disclosing these in their financials for these indefinitely lived credits, which is kind of a bizarre thing to do.
Well, yeah, because it's like, well, are you now trying to maybe give up other credits? So there's a loss regardless, right? Because you don't want to stop claiming the R&D credit because you're trying to use these carry forwards. So it's because still credits are very valuable to companies, right? Because of the dollar for dollar reduction. So yeah, it's become something that I don't think we anticipated initially because of the way that this rule is working.
Yeah. And one of the really counterintuitive things it took me a little bit to learn when I first started practicing tax was that cash tax for a publicly traded company is almost irrelevant, right? That it is really book tax, the effective tax rate, that is what executives care about.
Yeah.
That's not true this year for certain companies. And what are the dynamics that are making, there's still some companies that said, I don't care if I have a hit to earnings, I need the cash. What's going on there?
Yeah, I mean, we still have taxpayers or companies that ultimately are saying, we care about cash, what can we do? And the normal kind of, the world that I live in most of the time is kind of this planning, right, of accelerating deduction, deferring income, to ultimately do cash planning. However, the issue now is, I have to be aware of all these other concerns. Let's just say if there's a limit on the interest expense deduction. So if I'm now reducing taxable income, let's say I'm finding some deductions to accelerate, now that reduces ultimately also the ATI, the calculation ultimately, right, for the interest expense limitation. And so I'm limiting the interest expense. And so whatever number I initially came up with respect to the acceleration of the deduction, I now have to consider that there's a trade-off. And so I have to ultimately find a lot bigger numbers in order to make it worthwhile, and have to consider all these other potential areas that are permanent issues. And a lot of companies usually like have to weigh, okay, where do I get to that sweet spot around, yes, I'm going to try to do some cash planning, but I'm not going to completely, undo that with hurting myself on the permanent basis, or like some of these other provisions that could be permanent. So it's a lot of modeling that companies have to do, and we have a lot of requests where companies are trying to figure out, we're coming up to year end, what are they going to do for provision purposes? Because a lot of these provisions too, on the federal side, you can make the decision by the time you file the return. So there's still some time, but obviously now companies have to start thinking about, okay, what are we doing for year-end purposes to understand what's the direction that they want to go into.
Because you have to tell your investors something
Yes.
today, even if
Yes.
you have a decision that you can make, say, in April or March.
Yes.
Or even estimates, right? You're doing it for estimate and extension purposes.
Yes.
So you want to project it for fourth quarter and into your extension. If I know I'm going to make this thing to drive my cash liability down, you can keep the cash today. And
Yes.
what I'm hearing from my clients is, like most organizations, we're looking for cash for investment purposes, right? We are investing in AI, we're investing in our staff, we're investing here. So part of the pressure is they're looking for ways in which to get that cash, and taxes is a good way to do it.
Yeah.
Yeah, definitely.
So last question on this, and then I want to turn to Rob on the state aspects. But I'm hearing a lot of companies and reading their comment letters to Treasury basically saying, hey, you guys realize this CAMT thing is undoing the incentive you were trying to create for companies to invest in research and build new factories and products. Any expectation or hope that would eventually show up in regulations? What are we hearing about this?
I mean, potentially, it does feel like a little bit with some of the more recent guidance that they're in a sense trying to take a little bit the bite out of KMT. And so we'll see if that's ultimately the direction, because clearly, as of now, we don't have a repeal, or they ultimately didn't address it with most recent guidance. But at least from what we've heard, is there potentially a look to see how they can come up with future guidance in order to maybe not make it as impactful for companies, especially, given this ordering rule that I was talking about.
Okay. All right, Rob. So that was pretty complex, right? It's sort of like 3D underwater chess, the cliche. And now we get to add the layer of state tax on top of that. And you kind of described a separate chaotic environment where some states may have adopted the code as of a certain date. Some do it on a rolling basis. Some will never do it because they just don't like the policy outcomes. So how are you helping clients think about this, and what are the issues they're running into here?
It's really a tracking mechanism, honestly, for the next month, or not month, year. And we did this as part of TCJA, and it happened with the CARES Act as well. You got to kind of know your starting point. So we start going through and saying that, hey, for example, California just updated their code conformity, right, as we talked about a little bit previously, but yet they have decoupled from 163J completely. There is no interest limitation in California. They have their own depreciation rules. They allow for full expensing in R&D 174. So where we're talking about, hey, look at this great thing we're getting for federal purposes of domestic R&D expense, you actually get both in California and always have. So when we start unwinding it for federal purposes of, hey, you're going to get this big deduction in 2025 or 25 and 26 if you elect, in California I have to unwind that and say, no, not so much over there, because I already took it. So it really is, we've been dealing with this really since 2001, 2002, when bonus came in. And we've always had this disconnect, but it really started with bonus depreciation back in the day, where states started decoupling from depreciation because they saw it as a fiscal hit. And now with all the other provisions, they've just done it. So it's not just one issue we're dealing with, it's multiples. So, and the key of it really becomes, as you're making decisions on the federal and international side, being part of that process so that we can say, we need to do certain things on the state side to model it out differently. We don't adopt on the state side CAMT. There's only one state that adopts BEAT on the portion basis. So those provisions in and of themselves don't mean much at a state level, but all the decisions you're making around them federally of whether to capitalize your R&D expense, or if you're going to elect out a bonus, we are conforming to those or not conforming to those. And it's those things that we care about, or BEAT if you waive expenses. Those are the pieces we're trying to pull through and say, here's the state impact. And then in some states, we can make different decisions or different elections as well. And last but not least on that topic, think about like state R&D credits. California, again, another big state, an example, has a very favorable R&D credit, except, right, because of their budget deficit, they put a cap on it this year, right, in 24 and 25. And so you only get $5 million of R&D credit, you get to carry it forward. So if some of these provisions in the federal are impacting it, or you're saying that I'm going to not invest or whatever, you could drive up your tax liability in California and not have R&D credits that you're used to cover it.
So, yeah, that's one thing I wanted to get into. It is a lot. But it sounds like one thing you're saying is this is not just an issue of you're going to make federal elections and there's changes to the law, and you should understand that that will not always play out exactly as you expect on the state level. But I think you're saying something a little more than that too, which is some of these choices you were making for federal purposes will make you worse off for state purposes. Is that true too?
Absolutely. So you may decide you're going to capitalize R&D expense under 59E, right? And certain states are going to be bound by that too, so you're going to basically increase your state liability. But then, again, there's always an exception. Like you could make a different election in California. You could elect out of the 59E in California and therefore not capitalize it for that. Or there are states that are stuck in TCJA related to 174. So 59E doesn't really apply and I have to redo it. Instead of 10-year, I'm getting 5-year. So always the standard answer in state is it depends, right? And you kind of got to go through and decide. Some of it will be materiality. You're not going to run every state in every way, but when you're going through it, you're going to want to pull through these bigger issues.
But it sounds like at a minimum, some of these decisions where you may pay more regular tax to avoid the CAMT trap are definitely going to shoot you in the foot for state purposes.
It is, and that may be timing. So if we're thinking about provision, you may overall not care because you've just accelerated deduction. But states also, some of them have their own FDII or FDI deduction, so there are permanent hits as well, right? So again, thinking about rate and what you care about, is it a permanent item where you're never going to get it back, or is it a temporary item so that from a provision standpoint, it's a wash, but it's a cash issue? And so the punchline would be really, we want to be there when you're starting the process, right? Salt in the kitchen is the way I teased it out in the last webcast versus salt at the table when the dinner's already cooked, if we're going back to our holiday meal kind of reference. Mm-hmm. And if we're in the kitchen, we can kind of influence the way things are done. If it's already cooked and on the table, at that point, we're just adding a little flavor.
Yeah. Well, that was great, Rob. And Rob, Monic, thanks for joining us. I'm Wade Sutton, filling in for Doug McConey. Tune in next time for another exciting edition of Cross-Border Tax Talks.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.